Hi, let us talk about the core components. These are the 6 line items that actually move. And if you remember only 3 things from this entire session, make it receivables, inventory, and deferred revenue. Those are the ones where a founder's actual decisions shift the number day to day. Let's walk through them one at a time. Accounts receivable, money your customers owe you. Every single day you extend on your payment terms, you are financing your customers' operations for free out of your own pocket. I've seen B2B founders proudly close a large enterprise logo on net 90 terms and celebrate the win without realizing they just agreed to fund that customer's operations for 3 months. Inventory, raw materials, work in progress, finished goods. This is where hardware founders, D2C brands, and manufacturing businesses genuinely bleed cash. I worked on a climate tech hardware pitch, a company building industrial battery storage systems, where the founders had a gorgeous revenue growth story, but their inventory was ballooning because every unit required a 90-day production lead time on imported cells. Nobody had modeled that into their cash runway. It was the first thing that came up in diligence. Prepaid expenses, rent, insurance, software licenses paid upfront. Historically small for most startups, but it's growing quietly as SaaS tool stacks expand and everyone starts paying annually for their own vendors. Accounts payable, money you owe your suppliers. A higher DPO here, within reason, is genuinely free financing. It's the one lever on this entire slide where being slower is actually good for you. Accrued expenses, salaries earned but not yet paid, GST collected but not yet remitted. This one grows automatically as you scale headcount, so it's not really a lever you pull, more something you should track. And finally, deferred revenue, the highlighted row and the one I want you to sit with. This is cash you've already collected but haven't yet earned. This is the SaaS advantage in a nutshell. When a customer pays you 12 lakh rupees on day one for an annual subscription, that entire 12 lakh sits as deferred revenue on your balance sheet, and you recognize just 1 lakh a month as actual revenue. The remaining 11 lakh at any point in time is customer funded working capital sitting in your bank account, funding your operations months before you've technically earned it on paper.